So I've been getting some questions recently from my clients asking whatever happened to Silicon Valley Bank. So I'm going to give you a quick an answer as possible, starting with what's been happening with its customers, what's been going on inside the bank, and who is supposed to be watching over all of this as well. So just in case you don't remember, the collapse of Silicon Valley Bank was basically the biggest bank failure since the global financial crisis of 2008, which makes it also the biggest bank rescue since that time as well. So looking at the bank itself, it specialized in the local tech community and serving startups. So what was the big scary thing lurking inside the bank's balance sheets that we all had to worry about? So if you remember Econ 101, banks basically take our money that we deposit and then turn those into long-term investments by lending them out to other people. So the banks don't usually have everyone's money on hand all the time. If someone's usually making a deposit over here, they're usually making a withdrawal over here, it usually balances out. So that means that if everyone asked for their money back all at the same time, the bank wouldn't have enough money to pay everyone back all at once. This is the risk of being a bank. So that means that one of their jobs is to manage that risk as much as possible. So this is supposedly where Silicon Valley Bank misjudged that risk. They took that money and they invested into long-term investments like government bonds and long-term securities, which generally are pretty safe. But they're basically locked up into long-term investments, and those investments particularly are hurt if interest rates go up, which of course they did quite dramatically and very quickly. And you know who else was hurt by those high interest rates? The customer base. Basically the tech startups and the tech companies. So when interest rates were low, investors looked around at the environment and they said, you know what? We're not going to get a really good return over there. Why don't we put our money into a startup and we might as well just go for a big swing since we're going to get such a low return over there. Why don't we just try and get something big here and see what happens? So like if you had a dog walking app, you were getting like $100 million, or you had a Wi-Fi enabled juicer, here's 50 million. But all of a sudden with higher interest rates, that meant those investors could now get decent return in a safer way. Forget that Wi-Fi enabled juicer. So this left the bank hurting on both sides. They were hurting from those long-term investments they had made, and their customer base was hurting because they weren't depositing as much. So the question is, why didn't they manage the risk better? Well, the simple answer is that they probably wouldn't have made as much money. But the real question is, could the bank have weathered that high interest rate storm? Were they inevitably doomed to fail? This is where the next key part comes in, which is the customers themselves. Silicon Valley is a pretty close-knit community, and as soon as wind got out that people were withdrawing their money, everyone else started doing it. I think this might be the first bank run done maybe by group text, who knows? But 90% of the bank's deposits are over the FDIC $250,000 limit, so it was 1,000% rational for people to try and pull out their money because they didn't think they were going to get it back if they're keeping their like payroll accounts there. So people started pulling their money out, and you saw $42 billion leave the bank within one day. So who was supposed to be keeping tabs on what was going on? Well, back in 2008, Congress passed the Dodd-Frank Act, which actually provided some more stringent regulations for banks of a certain size. So one of the things in the Dodd-Frank Act was they classified a large bank at about $50 billion in assets. But what happened over years of bank lobbying is they shifted that. So $50 billion for regulatory purposes all of a sudden became a medium-sized bank, and $200 billion became what they considered a large bank. And I think it's important to note that Greg Becker, Silicon Valley Bank's CEO, actually was a proponent of making that change. And also worth note is that Silicon Valley Bank's assets in their last annual report were $212 billion, which makes them medium-sized for regulatory purposes. So the question is, would things have been different if they had been a large bank? We can say that regulators would have been more aggressively poking around in Silicon Valley Bank's business, making sure they had money set aside just in case there were certain things that happened. I don't know, like interest rates going up as an example. And they also run the bank through stress tests. I'm sure you've heard of that in the news. It's really kind of interesting, actually. I looked into it. So essentially what they do is they run the bank through like a simulation. They say, what would happen if these different things happened? It's actually published on the Fed's website, and you can go to their website and check out and see what they tested for. And funnily enough, in 2022, the Fed tested for massive unemployment, a collapse in asset prices, plummeting GDP, but funnily enough, they didn't test for an increase in interest rates. And that is, of course, one of the things that took Silicon Valley Bank down. And of course, that's when the FDIC stepped in and insured everyone's deposits and tried to prevent further bank runs and contain the situation, which it seems like they have for the most part.